All right, so chapter 5, pattern 5, top and bottom reversals. Okay, this is a pattern that I will trade occasionally. I had a killer reversal, when was it? On GME that we'll probably end up adding to the classes soon. So on GME, if you recall, this was a couple days ago, we had this really strong sell-off and then the bounce off the low. So let me just look at the 5-minute chart, and it was pretty epic. It was right here. This was the biggest sell-off actually I think I've ever seen. From $380 a share to $112 and then bouncing all the way back to $300. Okay, we don't see that every day, but we do see reversals on varying scales. Sometimes they're usually quite a bit smaller than that. But when we see a series of consecutive red candles, the first candle to make a new high, we can interpret as a possible opportunity. And you're mentioning there VXRT today. So VXRT today, this one had a pretty strong sell-off, but you know what? Actually, as this bottomed right here, despite selling off from 25 to 11, it was a bear flag, and then it went lower. The reversal on this was clearer in this section right here, but not quite as, I mean, yes, that right there was clearer for sure, but typically it's out of the extreme that you expect the big bounce, and this one didn't really do that. It kind of gave another sell-off lower. So a reversal pattern has the following characteristics. In a top or bottom reversal pattern, we look for a long series of consecutive candles, typically with increasing volume, and then we look for the first candle to change directions. You could do this on the 1-minute chart. You could look for 10 plus consecutive 1-minute candles, whether it's red or green, and then look for the first one to go the other direction, knowing that it's probably because you've got such a strong wave forward that when it does finally shift, you're going to get a decent reversal in trend, whichever way you're going. So this is an example here of a stock higher price that went from 44 up to 47. And look at all those candles in a row. You've got 3 candles in a row, then 1 red candle. Actually, 4 green candles in a row, then 1 red candle. Then 2, 4, 6, 8 green candles in a row. So this was hitting one of my scanners for having 8 consecutive green candles in a row. And it was consecutive both on the 5-minute and on the 1-minute. So there we had really nice multi-time frame alignment. So the reversal scanners are just looking for stocks that have consecutive candles. That's what we're looking for. And usually I think I have it set as a minimum of 5. So at least 5 consecutive candles, green or red. The best setups will be when you have it lining up both on the 5-minute and on the 1-minute, because you take your entry on the 1-minute and you know that if it drops, then it's going to confirm on the 5 as it sells off. These can be more difficult to trade when the 5-minute's really obvious, but the 1-minute is choppy. Because then we're like, wow, by the time I'm getting 5-minute confirmation, it's already down quite a bit off the high. It feels like I'm kind of chasing it. So that can be a challenge and a little bit of a struggle, but the best ones are when we have that multi-time frame alignment. I will also say that you won't see me trading this a whole lot. I did trade this more earlier in my career, and I traded it more during periods of time when momentum was really slow. But when momentum is hot, usually I don't trade these because, you know, your best case scenario is a short and then a pullback down to the 9 moving average, or maybe the VWAP if you're really lucky. Or if you are buying a dip, maybe a pop back up to the VWAP. And yes, in the case of GME, that did provide a lot of opportunity. However, in most situations, we don't really, there's just not enough juice on that trade. There's not like enough meat on the bone. So I just don't usually feel like it's quite worth it. Here, though, you can see, even on Tesla, consecutive green candles, first doji and then a red candle, pullback. Consecutive green candles, first candle to actually make a new low was here. It was a little false breakout. Then it pops up a little higher and then reverses. So these are the type of setups that we do like to trade when we see them. And so, you know, that's a pretty simple explanation for reversal patterns. There are times where we could take a reversal. Well, so just to back up, usually these reversals that I would trade will be when the stock is either hitting high of day or it's hitting low of day. It's got to be like GME. It's got to be usually at the high of day or low of day. However, sometimes you could have, you know, like let's say here you have 2, 4, 5 red candles in a row, and you could do a little dip trade here, but I wouldn't traditionally call that a reversal. I would more say that that's a dip off the moving average. Maybe it's a dip off the VWAP. It's not really a reversal trade because it hasn't sold off enough. It's not really at the low. It's more of a dip trade. A true reversal is when a stock is very extended at the high of day or low of day, and we're doing that reversal off those extremes. So think of a rubber band getting stretched out when it gets really, really, really stretched, and then you let go and it snaps back. That snap is where we want to be holding and riding that trend as it's shifting. So these are setups that occur more often in large cap stocks. In small caps, intraday, usually the small caps are strong enough that this doesn't happen. And even on a day where you have a small cap stock that's a little weaker, like today, for instance, on Sino, it never really gave like an extreme washout with a opportunity for a dip reversal. VXRT was a little bit better, but often, CBAT, often intraday, the small cap stocks that we're trading, they usually don't sell off hard enough and quickly enough to really give us a good setup for a dip trade, or for a reversal trade. All right, so a quick pattern breakdown of reversals, and we'll continue on here to chapter 5, pattern 6, the break of VWAP and the fade off the VWAP. All right, so now we're going to talk about pattern 6, break of VWAP and fade off VWAP. So a little bit more detail here to add to what we were talking about on moving average pullbacks in part 3. So the volume weighted average price, as you should already know, is it's a moving average that factors in the volume that occurred at each of those prices. So rather than just being a traditional moving average, it's weighted with volume, and it's called the VWAP, the volume weighted average price. It's very typical to see consolidation just above or just below the VWAP because the volume weighted average price is such a significant level. It's the average price of the stock on the day, including volume. So it's the equilibrium, really. And so anytime a stock is at it, it's kind of at balance. When it starts to get above it, it's getting extended, but can certainly be extended for long periods of time. And when we're at extremes and it starts to reverse, sometimes we look for a return back to that equilibrium point of the volume weighted average price. So this is a traditional, this is a beautiful VWAP breakout right here. So the volume weighted average price is our orange dotted line. And this stock was strong pre-market, sold off hard, and then kind of consolidated sideways. And as you can see, it was sort of ascending back up to its equilibrium point. It tapped it once here and then faded, tapped it once here and then faded. So each of these could have been places where a short seller would say, I think this is going lower. I'm going to short it at its equilibrium point for the VWAP fade and the sell-off lower. That's a common strategy that we'll talk about in our short selling strategy chapters. However, the stop is always if it breaks back over VWAP, and in this case it did, and because inevitably you have a lot of short sellers stopping out, and you also have long traders going long, you have an imbalance to the buy side in buy orders. Now, a break of VWAP going down can create an equally big red candle as long traders bail and short sellers go short. But in this case, the breakout to the upside creates that big surge. First pullback gets bought up. Second pullback bought up. And even the third pullback bought up as it goes from $7.60 all the way to over $10 a share. So this is a really nice VWAP breakout. Here's another one. The stock is strong pre-market, pulls back below VWAP, back above it, back below it, taps it and is right under it at the open and sells off. It comes back up and tries to break it here, but it can't break it and sells off more. So a VWAP fade, a win on the short side. Fades down and then curls up to the VWAP here at 14, consolidation right next to it, and then surges through that level, the VWAP breakout. Now, if you didn't have that line on your chart, you wouldn't realize that there's something that's indicating resistance here and then pending breakout here. You just would have no idea. So this is reinforcing the importance of using the VWAP as a technical indicator, no doubt about it. And then given it's a significant technical indicator that a lot of traders are watching, the question just is, okay, well, how do I actually trade it? And so that'll be covered more in strategy development when we're talking about the actual entry and exit points. But for right now, I just want you to see this pattern, which is break of VWAP. It is a powerful pattern. It really is. Next to the ABCD pattern, it's one of my favorites. Let's see. These are some trades that I'm just going to move this here for now. All right, so let's see. Okay, so let's look at another one. All right, so the VWAP fade, then the VWAP breakout. All right, so in this case, at the open, it breaks VWAP to the downside and fades. It curls back up and taps it here, which would have been a short, and then a fade off that level. And then all of a sudden right here, it breaks it and goes from $5 to $8. an amazing break of VWAP, a bounce off the VWAP, moving average pullback type of setup down to the 20, bounces off that level, kind of consolidates back up, then breaks it here, taps the VWAP, bounces off it, and then flushes and breaks through it, back down to $5. So that is a very important line in the sand to be watching. Here, a couple examples of very clear fade off the VWAP, an attempt to break that level, but it couldn't quite do it. Another example here, 1, 2, 3 fades off the VWAP. So kept trying to break it and then fading. So as it comes up to that level, because there's a lot of active day traders that are, putting their shorts or putting their position, using the VWAP to kind of position themselves. So active day traders who are either saying, I'm going to short off the VWAP or I'm going to go long to anticipate the break. If they're wrong and it fails, then you can get that flush coming back down. If they're right, then you get that big breakout. Looks like I've got the same one in there twice. I'll go and fix that. And with that, we'll go into Chapter 5, Pattern 7 on horizontal and ascending, descending support and resistance lines. All right, so Chapter 5, Pattern 7, horizontal and ascending, descending support and resistance trend lines. So the patterns around these very logical lines in the sand. For any intraday pattern, you can draw trend lines to help better visualize the support and resistance lines. I won't always do that. Sometimes I will. Sometimes they are, to me, so obvious that I don't feel like I necessarily need to. In the case of Sava, where I knew that the previous day's high was 74.50, I knew that was there, but I went ahead and drew it anyways, and that way I just remember that price is there. So that's a horizontal level. The high of day today, I could have also drawn a horizontal level at about 71.85. So, those are levels that we'll draw, and those can create some patterns. And you'll notice how the stocks will trade around those critical levels, therefore kind of creating those patterns of maybe a flat top breakout underneath the critical level or a bull flag underneath that level or something like that. But drawing them can be helpful, especially as a beginner, just to have a clearer visualization of where these levels are. So this is an instance here where by connecting these 2 points and then it draws forward, extends the line forward, I can now see pre-market, or as the bell rings, as it sells off, how it's bouncing right off that level. Then it squeezes up, then it bounces off it again, pops up, then it breaks it, it sells off. Then it curls up to it and it can't break it. So that's an ascending support line. Initially, it was support here, bounce, 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 and then it was resistance after it broke and came back up to it. Now, at a certain point, if the stock is no longer respecting that level, that may be a time where we would just delete the line and say, all right, it's not really working anymore. But as long as it appears to be working, we keep it. So here we have some ascending support in this area right through here. Not perfect, but close. And then a little descending resistance right here. And notice how we have the crossover where now as it breaks back down, this level kind of becomes support for here, but then this level becomes resistance coming back up. And that's not uncommon that you'll see that. Something that I find to be very common, especially with some of these really volatile stocks, and look at that, that's a bounce right off the volume weighted average price there on that one. But for instance, on something like this, even though I've said I don't really like to draw super steep trend lines, let's just say we did draw a trend line kind of like that. Now, if it comes back up, we know that we're going to run into resistance at that level, at that trend line. And maybe it's not super significant, maybe not a lot of people will draw it, but as we get further into the classes, you're going to see more and more examples of levels kind of like that, where you're like, wow, that really is creating a problem. It's resistance. It's right there. Here's another instance of very clear ascending support pre-market. It then breaks. And if it had come back up anytime during the day, I still would have been looking at that line. Because it was so valid earlier, I would consider it probably to still be worth keeping on the chart. Here's another one, very clear extension of ascending support from back here up forward. And if it break below it, then as it curls back up, it's going to be resistance, or as long as it can hold here, then that ascending support will kind of keep providing support as the stock comes a little bit higher and a little bit higher. Another example here of a very clear ascending support. This is actually on a 10-second chart. So it's a very tight range here of about 8 minutes, but it was clearly holding this level and then it broke. And now if it comes back up, it's going to run into that level coming back up. This is another example of a long kind of period where you have, it comes back up and hits its head there, it tries again, and then finally it breaks it. And it does it right around the volume weighted average price. So you kind of have two setups sort of working together there in that moment. On this one here, you can see we've got this very clear ascending support as well. This descending resistance could be an issue. It's not. This is a bit of a wedge here as it's sort of getting forced into this area. And sometimes when that happens, you think it's got to break. It has to either break out or up. Sometimes it does just kind of keep going straight sideways. And then you're like, all right, well, now I guess it's below these levels. I don't know. This is weird. So sometimes they're respected well and other times they're not. This is one that carried over from the previous day here, holding support, breaks below it, then that becomes resistance, then surges through it, then back below it, then comes back up to it, back down, and then right back up to it almost to the penny. So when we're looking at stocks that are possible multi-day continuation patterns, like Sava, for instance, it's a good idea to do our analysis on it to ask ourselves, are there levels from yesterday that are going to carry through today to create issues? So let's just see for the heck of it if there are any issues or any lines from yesterday. So I'm going to switch to the 5-minute chart just to make it a little easier to see the price action. So obviously yesterday we had some, some strong moves to the upside. I don't know if any of these are really all that valid. I don't know. It's moving up and then it came back down. It doesn't really seem like that's all that significant. Here, I don't know if that one's really that significant either. So maybe those ones are nothing really. What about back here? Yeah, maybe a little something there. It almost seems like it holds. It's not always the case. Some stocks seem to have trend levels and lines that are respected better than others. And for us, considering long trades on it, that could have been an area right there. Maybe. It got above it, but then back below it. This has got such a huge range. It's definitely a little tricky. But yeah, so maybe not any good examples on that particular stock. That's okay. Here, 10-second chart again, moving up, then selling off. This was the Airbnb IPO. So on this Airbnb IPO, I was long down here, and I was holding. As soon as it broke there, I was like, nope, I'm out. Then it's starting to sell off once, comes back down a second time, comes down a third time, a fourth time. Now it's starting to look like it's very clear line of support there, trend line. So maybe we don't use that to base any trades, but it's always better to see it and not use it than to not even know it's there and to potentially be buying right into that level. WWN, very volatile stock from 13 to 60, then back down. So this was crazy. This one was seriously insane. In any case, notice here this ascending support line right here, breaks below it, comes back up, hits its head above it, right? So it's very clear. This one, again, that trend line from earlier, extending it out, seemed like maybe there was something there. Not really sure. That one might not be the best example. Next one here, SCPS, connecting these lines earlier are sort of in here. You can kind of see how roughly it is respecting these levels. Breaks below it, and that's not great. Another one on WNW, I think perhaps the same one as before, but with a close-up on the 1-minute chart. IG, another one right there, as you can see. So again, it gets below it, tries to get above it, back below it, surges above it, now it's holding above it. So it's this sort of, above and below these levels that we are really watching. There's a 10-second chart on PEC on that nice move higher. So if it's above these levels, we certainly would consider it to be bullish. If it's below those levels, we would consider that to be a bit more bearish. Above it here, holding, breaks it, comes back up, running into the resistance at that level. So now it may need to consolidate and kind of recharge before it can truly break over that level with some strength and really make, a serious move. This is a perfect example of it. Let's see. So this was as it was first forming, and then later as it's coming back up, we just know we have that issue right there. And until it can break over that level, it's just going to be a bit of a problem. So let's see. Then we've got, okay, so that was the end. So now let's go into pattern 8, head and shoulders. Again, during live trading, you're going to see so many instances of me drawing these trend lines. And if you go back into the starter, we'll talk a little, I think we did a number of examples of actually drawing those trend lines. And I think we did some examples of it also already here in the pro classes as well. So if you need a refresher on those, you can jump back to those classes. So now let's continue on to Chapter 5, Pattern 8 on the head and shoulders pattern. All right, so now we're going to jump into Chapter 5, Part 8, or Pattern 8, the head and shoulders pattern. So a head and shoulders pattern is not something I typically focus on or talk a lot about. Every now and then you'll hear me mention it or you'll hear someone else mention it. It's one of these patterns that is a little bit more of a kind of previous generation of traders, I think. I mean, you just don't hear about it a whole lot, but it's an interesting pattern. It consists of so this is essentially the arm right here. That's the shoulder. That's the head. That's the top of the head. That's the other side of the head. That's the shoulder. And now it's coming back down. So put a little smiley face in there, and that's his head. He has virtually no neck, but that's the head and shoulders pattern. All right. So, again, it's not one that you'll hear me talk about a whole lot, but every now and then we see it and it's just like, whoa, there it is. Yep, that's a head and shoulders pattern. So, let's look at this. So this is the arm, that's the shoulder, that's up to the head, that's the top of the head, that's coming back down, that's the other shoulder, and that's coming back down. So you see how it kind of has that rhythmic sort of up and down, up, flat, back down. This one's got a more distinct sort of head area, but so as it's forming on the upside, ultimately we don't know it's a head and shoulders yet. As it's forming on the upside, we see it as, oh, this is a bull flag, and it's continuing higher. Right? So it's consolidation, it's breaking out higher. It's when it breaks down hard here and then hard again here and goes sideways that now this becomes bearish because we're thinking it's going to sell off more. Right? So now it's like, okay, it really rejected off the top. Now it's gone sideways, it's stair-stepping down, and now we're kind of mirroring the move up on the backside. Because that's essentially what it is. It's almost like a mirror. The move up is then reflected on the move back down, which is not totally uncommon in the market that we see that in general, but with this particular pattern, when it presents itself, we consider it a head and shoulders. This is an inverted head and shoulders here, where, and this isn't, I mean, again, even as I look at this, it's like, this is not really perfect. So, well, first of all, you could maybe try to say that this is the head here. This is a regular head and shoulders. And then as it comes back down, you could say this is the shoulder, that's the head, and then this is coming back up. Right? It's flatlining here and then coming back up. So this is an inverted head and shoulders. This doesn't really look like a very clean regular head and shoulders. Inverse, inverted, however you prefer to say. But yeah, again, I just wanted to throw it in there because every now and then I'll mention it. And I've had students who are like, wait, what the heck is that? You didn't teach that in the class. So I just figured I'd throw it in here and now I can say, hey, yeah, I did teach it in the class. It was in Chapter 5, Part 8, Pattern 8. So now we've covered it, but we'll probably almost never talk about it again. All right, so with that, let's continue on to Chapter 5, Part 9 on bull traps and bear traps. All right, so now we're going to get into Chapter 5, Part 9, Pattern 9, which are bull traps and bear traps. We're going to talk about this a lot. This is going to be a longer section here because this is so important. Now, we all, from time to time, will fall into a bull trap or a bear trap if you're short bias. This is a little cartoon by Ben Garrison of the bull trap. Now, well, I guess this is kind of weird because that's like a gorilla. It would have been more accurate if that was a bear because the trap on GameStop was a short trap, and a short trap is a bear trap. When short sellers get stuck, it's a bear trap, and when long traders get stuck, it's a bull trap. All right, so this is a hedge fund gorilla trap, which I don't know, but they were short biased. So that's just a kind of funny one. So as you probably know, but for those that are watching this after the fact, GameStop squeezed from about $7-8 a share. Well, I guess this year is about $12 a share, all the way up to over 500, which was its pre-market high last week. And there were a couple of hedge funds. There was one big hedge fund that I believe lost about $6 billion on it. And there were other hedge funds that supposedly just followed that hedge fund because that one was so widely respected. So total losses at its peak were around, I believe, $20 billion. And I don't know, now it's come all the way back down. So who knows? Maybe they got back out, but still at 100 versus back here at, the 20s and 30s. So in any case, that was a bear trap, an epic one, and that created a short squeeze. And we will sometimes talk about the fact that a bear trap can trigger a short squeeze. When short sellers are stuck, it dropped, it looked like a good short setup, and then it just totally rips the opposite direction. That's a bear trap. And likewise, when you have a long setup like this little consolidation right under here, and it does a breakout and then quickly reverses, well, that's a bull trap. I got caught in a bull trap today on Sino, which was pretty nasty. This one on the 1 minute chart was right here, and I was in stepping up pretty big with the share size right there. I liked this for the breakthrough 1225. I had 30,000 shares. I stepped up to the plate. I stopped out as it came back down here to 10, and I lost 60 grand on that trade. $2 a share with 30,000 shares. 60,000 is approximately. I don't know exactly how much I lost, but I know I was up nicely on the day, and then after that I was up only about 10,000. So I went from being up, I think 75 or 85,000 on the day to up only 10 grand. One trade, and it was a bull trap. Now, I suppose you could say there could have been some red flags on this. It was a topping tail back here. It had sold off a couple times a little on the hard side, but in any case, I'm pretty sure it was right here. Now, no. And now actually that I'm looking at the chart, I think my position was, sorry, it was right here. It was right here. I actually did take this trade, but that wasn't, I don't remember if I lost on it. This was the one here where I was actually buying this pullback and trying to anticipate the first candle to make a new high. So sometimes when we talk about getting in a little early to anticipate a trade, we will talk about the risk, which is that you don't have confirmation. Confirmation is when that first candle actually makes a new high. But you pay a price for the confirmation, which is that you're buying higher. If I take a trade a little bit lower and it's what we would call a dip trade, and I'm getting in to anticipate that breakout, usually that means I have a better average cost, and if it does go the wrong way, I can usually get out faster unless I have massive size. So anyways, but this is a typical bull trap right here, which was a squeeze up from 340 to 420, a pullback, first candle to make a new high right here. It pops up, it doesn't go higher, it immediately reverses, and now people who bought are trapped. It reverses. Those traders are selling for a loss. Short sellers see the weakness, they're pressing the sell button to short it, and there you get that drop. The first pop and then continued sell-off on a small little bear flag. So a bear trap, bull trap is when a pattern begins to resolve as you would expect it, and then quickly reverses. These quick rejections are generally unexpected, therefore they catch traders off guard. People go long only to instantly get stopped out, or traders go short only instantly to get stopped out as it rips back up. The best prevention of getting caught in a trap is to focus on stocks that have high relative volume. However, even then, it will sometimes happen like it happened to me today. So we'll discuss in more detail as part of the strategy development about making better decisions, perhaps than I made today even, with reducing share size as you start to generate profit, so you don't put yourself in a position where one false move gives back your entire day of profit. But sometimes you'll be in a mindset where the market's hot, as it's been for the last week and a half, and where you're going to be stepping up to the plate for some more home runs, not taking those quick base hits, and it'll work until it doesn't. And then when it doesn't, you've got to be quick to adjust rather than try to make back all the losses by continuing to be aggressive. So let's talk about this a little bit more. Being careful of bull traps, which we also sometimes would call false breakouts. A bull trap is when we see a bullish pattern resolve and then immediately reject. And so yesterday we actually had a bull trap on Sava, if you recall, which was right here. So that right there was a bull trap. It was the first 5-minute candle to make a new high. Now we know that this was a little premature because it was extended off of its 9 moving average. So it was a little extended up there. It had already made a pretty big move. And this wasn't much of a pullback. It was one tiny little red candle and then it popped right up. But it did, no doubt, encourage some traders to go long for the breakout. And it may have even encouraged some traders who were short to cover their short position. Sometimes when we see a premature breakout like this, while we acknowledge that the risk of a false breakout on it is certainly higher, we also can acknowledge that if there are short sellers that are trapped, if this keeps squeezing, they're going to be forced to cover. Because as a short seller, you might look at this and be like, this is extended. It's a premature breakout. It's going to be a false breakout, you know? And then next thing you know, it's at 56, 57, 58. And finally it's like, okay, you know what? I was wrong. Capitulation. I'm throwing in the towel, and off it goes, you know, as more short sellers cover and more long traders, you know, put on the pressure to the long side. So that was a bull trap there that did end up then recovering as it squeezed up to the high. This ended up being another bull trap right up here. So there was another one there. This was a break of VWAP, but then recovered it. So possibly a little bear trap there on the break below VWAP and then the instant bounce back above it. This morning, another bull trap on it right here. First candle to make a new high was a false breakout right there, that red candle. But then it breaks out here up through the highs and, you know, is looking stronger. All right. Now, I should say, so what creates a higher likelihood of a bull trap? And you probably could already speculate a few things, but one, when the stock is well extended off both its 9 EMA on the 1 minute and also the 5 minute. Two, when the stock has already made a really large move, which is another way of saying it's extended. It's anytime after 12 p.m. Afternoons. So, you know, again, this is, I'm going to justify why I'm going to go on a tangent here. So there are so many, my goal of this class is to give you kind of every little bit of my brain knowledge and experience that's up here about trading. And sometimes there's these little tidbits that I guess maybe I could have put them somewhere else in the class, but they just kind of come to me. So something that's important to recognize is that generally in the market, the volume peaks at the open. And the volume is usually really high at the open because these stocks are responding to news that came out overnight. And so both pre-market, but also right at the bell, we see really high volume. Traders who log in from Europe are certainly trading the open, which is usually around anywhere, I guess, between 2:30 and 4:30, 3:30, depending on where you are in Europe. I don't know. There's, I presume, somewhat different time zones. I'm not, I guess, the most well-traveled. But in any case, anyone correct me, reference? I know Italy is 6 hours ahead because that's the place where I've traded the most. So in Italy, it's 3:30 in the afternoon when the market's opening here at 9:30 in the morning. So a trader in Italy is certainly going to trade from, you know, pre-market to 3:30, 4:30, 5:30 local time, 6:30, 7:30. I don't know if they're going to trade all the way till the market closes at 10:30 p.m. and they're probably, or 10 p.m. and they're probably not going to trade after hours unless they want to be up all night. UK is 2:30, so they're 5 hours ahead. So, you know, for UK traders, 2:30 in the afternoon. I remember having a UK student who said, you know, he kind of phones it in on his job, like in the afternoon. So since he already does nothing and watches Netflix in his office, he was like, maybe I'll start trying to trade. So good for him for being honest, at least with me, not with his boss. But yeah, so the fact is you have a lot of trading activity right at the open. And you may even have, you know, I don't know to the extent Australian traders, what time is the US Open in Australia? I'm trying to remember. Is it 8:30 at night, or is it all the way? I don't know. Someone can say. But I know from Australian students that will trade. They usually are talking about trading the open, and then, you know, that's it. So Brian says 11 p.m. Golly. So it's 11 o'clock at night when it's 9:30 here. That seems a little funny. Well, it's Australia. I don't know. Toilets go backwards. Clocks are kind of funny. So in any case, they're ahead, but probably not off by half an hour. So 11:30 p.m. maybe? Anyways, the fact is, at the open, we see peak volatility. As the day goes on, most traders who make money will find their way out of the market, you know? And I mean, you know, I don't want to make the casino reference, but if you go to a casino, you're going to see a casino is going to have hours where it's really, really busy, and then people take their money and they kind of get out of there. You know, when you walk through the casino at 5:30 in the morning or 4 in the morning, which I did when we hosted an Inner Circle seminar in Las Vegas, because well, the market open. Las Vegas is you know, on a different time zone, so I had to get up super, super early. So I'm walking through the casino at 4:35 in the morning, and you know, there's Grandma. She's still on the slot machine, cha-ching, cha-ching, and there's other people, hazy, bloodshot eyes. They're still at the tables, and I'm thinking, you guys are all the losers. Why are you still out here? Well, that's probably what I look like after trading for 7-8 hours and still sitting in front of the computer at 3:30, you know, 4 o'clock to go into after hours trading. Why am I still trading? Usually I'm trying to recover losses and I'm doing something kind of stupid. And when we get into trader psychology and continue on some of the things we talked and touched on with Ted, we will talk about the comparison between trading and gambling, because there are some people that come into the market and they're simply gambling. They're just throwing money at, oh, I'll just place some money on this and we'll see what happens. I'll come back in a week. There are also some people that day trade as if they're gambling. But pretty quickly, you're going to realize that that's you're not going to have the same kind of beginner's luck that you might have with actual gambling. You're not. I don't think that many people are going to stick with that because it's not very satisfying. However, there can be days where people will fall into that. So generally, this was all to say that in the morning, we usually see cleanest patterns, cleanest follow through. And as we get later in the day, past noontime and later, things start to get choppy. I will consider trading in the afternoon when we have parabolic price action, like what we had on GBR. I think it was last week. This is a time where we can justify trading in the afternoon. This was very high volume. The traders who were still here were certainly capitalizing on it, and this is a time it made sense to dig deep because the market was hot. But generally, afternoons, if we're going to use a generalization, are choppier. So, and then also number 4, if a stock has already shown a tendency for false breakouts, it's very likely that it'll continue with that as traders get cautious holding around these critical levels, as we've been seeing on Sava, and also as short sellers start to get a little bit more aggressive to try to hit it short off the top and maybe feel a little comfortable holding if it goes just a smidge higher because this thing keeps doing false breakouts. However, traders who are fast can still be profitable during a false breakout. You could still buy the first candle to make a new high and take profit off the table. I'll actually show you an example of that today. So here's a live trading example, which most of the live trading examples I reserve for when we're actually doing strategy development, but let's just show this one here. So this was VXRT. VXRT, I was looking for the first 5-minute candle to make a new high, which was actually over 1245. Because there was a little bit of kind of 1-minute consolidation, I decided to take a starter at about 1220, which you'll see. Unfortunately, this was covering. Sometimes the way I overlay this is not great for the recording, but anyways, I just quickly recorded it. So I'm going to get in here at about 1220. All right, so we're waiting for it. I'm looking for kind of that sign of strength. There's 1214, there's 15, there's 20. Starting to pop up. My hand's coming down to the buy button, and I'm going to punch it in just a second. Now, this was kind of breaking out of this little consolidation. I thought if I get in at 1220, my stop can be at 12, which is a tighter stop. So I'm actually in at 1244 right here. So right now, I'm up $99, $54, $184, 54, minus 81. All right, I've got 4,500 shares. Now watch as it starts to curl up a little bit more. The first 5-minute candle is at 45, I've gone ahead and added here. I've now got 14,000 shares. Now, my 4,500 shares from 24, I could have sold it at 34 for $450 of profit. This does become a false breakout. I do end up losing money, but this one could have worked just as a base hit trade. I was going for the home run. Now, I'm here with 14,000 shares at 33. If it breaks over 45 and 50, yes, I will get a nice trade on this through the $50, which will certainly be more than $450. My target was 1275, which was the high. But now on the 1 minute, we're actually kind of double topping at this pattern, or at the top, which is not ideal. But there we go. There's 47.48. I'm in at 33. Now, yes, the bid is 40, so realistically, I'm not even up 10 cents. But I could sell it maybe between the spread for $1,400 of profit, maybe. But, this was me going for the big trade, and this is typical Ross right here. I flew a little too close to the sun. This is so typical of me that instead of just taking the dang profit, I hold for the bigger move. It comes back down to break even, and now there's a feeling of, well, I don't know if I can even hit the bid with 14,500 shares because there's only 500 shares on the bid. If I do hit the bid, it's going to flush, and it's going to be a big surge of red on the level 2, which is only going to just guarantee that this is a loser. So now I'm kind of waiting. I'm hoping, okay, well, sometimes it double tops. Let's give it a chance to curl back up. It was a descending resistance line here that we broke above. Then we came back and tapped it. So I'm like, okay, bounce off of it. Yeah, that makes sense. Let's see if we get that break back over, 45. So there, we back to 45. Here we go. All right, this looks good. 43, 45. Here we go. It's game time. 47, 48. I'm going to add. Wait a second. Why is it back at 27 and 31? And so this ends up being a false breakout, and it does end up dropping back down. And you can see I lose like 3,500 bucks on it. A perfect example of a trade that if you wanted to just take a base hit and you just wanted to get your 10 cents on it, you could have probably gotten your 10 cents. But when you sometimes step up and go for those big wins, that's also where you're going to be at a higher risk of getting smoked on a false breakout. So there's no doubt about the fact that false breakouts can be painful. False breakouts will turn you into this pretty quick. This is a picture of me. There's a real picture of me after the last false breakout that I got caught in. I'll be honest. These will age you. These stocks can age you. Now, just for reference, now I know we gave Uncle Steve a little bit of a hard time, but now as I look, I'm kind of doing the math here, and golly, this looks like I'm looking at Uncle Steve. I'm looking right in the mirror. I'm looking at my future. So, oh boy, we are, all I'm going to say is that I'm buying Rogaine today. Is that publicly traded company? I'm buying Rogaine stock. Because that's the direction I'm going, especially if I keep getting caught in these kind of false breakouts. So that's where we're at. Okay, so this is a bull trap. There it is. Look at that. So 485, and it rips up through 485 to 5, and look at that breakdown. It just immediately rejects. It's instantaneous. It's so fast. 5-minute false breakout, the 1-minute false breakout. Is there anything that we could have done to avoid this? Well, this one, similar to today, does have a large topping tail at the high, but there are also times where we see that large topping tail and they do end up working out. So, but yes, that was a red flag and it did come down hard after that first squeeze. So that was a red flag. High day volume was on green candles though, and we're a little extended off our 9 moving average. Here's another one. Now this is right here, right in there, over 220. First candle to make a new high. It pulls back almost to the 9 moving average. High volume ramp up, light volume pull back. Now here you can see how it dropped under 2 and then rips up to 220. Because of that, this does not have multi-time frame alignment. We have a first 5-minute candle making a new high, but the 1 minute is already extended. And I'm just getting word that Johnson & Johnson owns Rogaine. So I am going all in on Johnson & Johnson stock for me and Uncle Steve. All right, so thank you for that. So the problem here is that this entry, which obviously some people took, and I don't remember if I took this trade or not, but while that entry made sense on the 5-minute chart, the 1 minute didn't support that entry. So this is where trading with an absence of the 1 minute chart, while it might help avoid over trading by not getting in and getting right back out, in that case, it might have gotten us in. Although your proper stop is the low of the pullback, and it did end up working. But remember, in this situation here, all of that hold time is exposure risk. It's exposure risk that the company comes out with, a secondary offering or bad news comes out. So to just be holding, again, that's only 5, 10, 15, 20 minutes of hold time right there, but I still generally wouldn't want to be doing it. All right, so we get a false breakout there. We get another false breakout right here, and then finally, a little bit later, it does end up breaking out. Okay, so here's another one. This was a very clear one up here. Red topping tail candle, it drops down, it rips back up, double top at the high. So a double top right there at the high, that's not what we love to see, and it rejects. Now, in this case, this might have been enough of a move to make money, but choppy for sure. Down in here, this was a little false breakout as well, and then it started to curl. This was a little premature, though, as you can see. All right, this is back to the one that was on that first screen, which is that squeeze up, the pullback, first candle to make a new high. It's extended with topping tails, right? Here's another one. So squeezing up, first candle to make a new high right down here. Despite that red topping tail candle, it goes higher. Then it pulls back, and what is at this point almost a cleaner setup doesn't work. It squeezes up, and that is a shooting star. That's an inverted hammer, right, with that topping tail. So that's a perfect example of the shooting star. Here's another one. This one now at this point has a history of false breakouts, because you see first a false breakout here, then another false breakout here in this area, another one kind of right in here, and then when it does finally squeeze from 240 to 270, it pulls back, and another one here. So now this is where it's like, all right, fool me once, you know, shame on you. Fool me twice, shame on me. Fool me 3 times, wait. Anyways, so NVLS. So we have the squeeze up here from 3 up to 360, the pullback, first candle to make a new high. Once again, false breakout. This one, a little bit of a topping tail up here, but not that bad. Okay, so here we have 650, a nice breakout pre-market, very clean up to 7. A rip up with a shooting star at the top. It looks like it's going to fail. And then, boom, it keeps going higher, up to 8, up to 850, pulls back, almost looks like, yep, false breakout right there. Now this is a bull trap right there. And then when it broke down, that could have been a bear trap because it looked like it was going to drop, and then it curled right back up, back to the high. So now that could have been a bear trap in that lower circle where it really looks weak. You've got the bull trap, so now you're thinking, all right, we've got this. And then all of a sudden, uh-oh. Here's another example of a bull trap and a bear trap. The bull trap is right here. Then the bear trap is the false break of VWAP. And then a bull trap up here, right there. And then another bull trap right here. So you can see, sometimes we see it, you know, going both directions on the same stock within a few minutes. This had a nice kind of move here on the 1-minute chart, a nice ABCD pattern that then ramps up through the high, topping tail, pulls back, and it still goes higher. A doji still goes higher, that red doji. Hits a high, pulls back. That was a bigger red candle right there. It pops up, false breakout, flushes down. Now we're starting to stair step down. And this almost looks like a head and shoulders with the shoulder, the head, and then the side of the shoulder kind of coming back down, but not perfect. This is another one here, CRIS, false breakout right there. Another little false breakout right here, another one right here, another one right up there. So several false breakouts in a row on this, little bull traps. These probably, hopefully wouldn't have caught us too badly, but they're not, you know, they're not great. In this one, 5-minute setup right there, false breakout, bull trap. So it drops, it rips back to the high, drops back, goes back to the high, but a dramatic false breakout right there. So these types of quick rejections, you know, these are tough. They're certainly not fun when we see that happen. You know, and again, on these ones, sometimes the topping tail and, you know, these little sort of highs are indicators of possible, you know, it's a warning sign when we have stocks that are really choppy, but sometimes we have everything that looks pretty good and it still does a false breakout. XBIO, high is 457, pulls back, first candle to make a new high. It does curl back up, and then this is starting to form like an ABCD pattern and then starts to break out right there. And that break, and then quick rejection. Here you have this one, the ascending support, a 1-minute false breakout right in here, which is a little hard to see. Another one right in here, and this one, I don't know, just sort of chop in there. Another topping tail up here. This is a false break of the VWAP right here. So it attempted to break it and then immediately reverses and halts going down. The worst situation for me, the worst situation is when I buy with big size into a false breakout and it reverses so violently that it halts going down. I've had, some of my worst trades have been like that, which makes sense because obviously those are going to be just horrible trades. In the case of, you know, having a trade like that where I also had really big size. So just for instance, on like Sava, earlier when we had that sort of attempt break at 80, we'll actually look at the 10-second chart on this. So on this one, this area right here, okay, so you've got the high of 80.05, you've got the high of 80.30. So we had a big seller at 80, and it broke that level first by 5 cents and then flushed down $1 a share. Then it broke it by 30 cents and dropped down $2 a share. Now, if this had gone lower, 77.50, 77, 60, you know, 76.50, all of a sudden now anyone who bought for that breakout is panicking and bailing out, and that's where all of a sudden you get that big dramatic sell-off, and those just can be so painful. They can happen so fast. GME, I don't know if there's There might be some examples of this yesterday. I think there was at least one pretty dramatic halt going down. Yeah, so it was right here, right there. It halted going down. I don't know, though. I mean, this, well, and even actually right here at the open, this right there in that candle, it looked like a breakthrough 57.97 and then just dropped hard. It was a first candle to make a new high. It was a potential setup, a higher risk one, but then halting going down, halting at 130, down $27 a share. Then here it rips through the volume weighted average price. We get the VWAP breakout from 108 all the way to a high of 154, and then it halts going down. But that wasn't really halting going down after a bull trap. That was just halting going down. So this is another example of the bull trap here, then the bear trap, and then the rip back up. So in a situation like this, if I got caught and lost on this, I see it do that, and then as I see it curling back up, I might think, okay, if this breaks back over 13 or the high of whatever that is, 1340, that's probably going to squeeze out early short sellers. So that's where I start thinking, if I was short, where would my stop be? And we might see a squeeze. Here you have this sort of bear trap, which was a break below the ascending support. It looked like it was coming down, but then it rips right back up. Now this was also still bullish in that it was near the volume weighted average price. It was above it. It was near the 20 moving average, but you can see how it did kind of drop and then immediately turned around. Then this right up here is a bull trap. Consolidation, break through the high, quick rejection from 10 back to 9. And yeah, to answer your question there about false breaks around the volume weighted average price, we do see that a lot. That's very common. So one of the challenges with trading a break of VWAP is, do we buy right here as it's breaking? Or do we say, listen, I'm going to wait for it to break, pull back, retest that level, and prove it can hold above it for the next leg up? And, you know, there are times where it's just going to rip like this, and if you wait for the pullback, you're not getting it till way up here, which you're going to feel like is a chase. And then there's other times where it, you know, maybe right here looks like it's about to do it and then just rejects pretty dramatically. We'll talk about that a little bit more when we get into the actual strategy around trading the VWAP. But yes, we do see false breakouts around that level, and we'll see them around a lot of critical levels. This here actually was a clean break of VWAP as it squeezed up there, but then a failed breakout over the $0.50 of 450. The sort of beginning failed breakout that we were seeing on Savo at $80, while I really thought it was going to break, the fact that it broke 80 by 30 cents and then came below is almost worse than if it doesn't break it at all, because it's that at that moment was a false breakout. Now, if it hits 80 and there's a huge seller, but it never breaks, then we're kind of like, okay, well, it still hasn't broken. But if it breaks and then comes below it, that's usually a problem. All right, go on, girl. So let's see. Now, in this case here, we have a double top, as you can see right there. And it did break that double top by like 2 cents. But I'm always cautious about buying double tops because of the fact that you can have traders lined up there to be shorting. So I don't think that's one that we would really get caught in. This right here, a failed break of the whole dollar of 6. It drops down to 560. The ABCD pattern breaks to the downside as it makes a new low, and then it surges right back up. The entry would still be at $6, and I'd be happy to get back in it at 6 if it was showing us that level of strength. It then goes up to 670. Here's another one on Hoth where you see this 1 minute false breakout right here, which was also the first 5 minute candle to make a new high. It broke, it didn't hold, and then it flushed back down. So the breakout or bailout mentality is going to be really important for really trading in general, for my strategy, and for trying to not get caught in bull traps or bear traps, and or if you are caught, cut the trade loose quickly, certainly before you're in a halt going down, just to get out of it. So if you can keep the loss small, then if the setup does come back up, maybe creates a short trap, a bear trap, and then comes back up, maybe there's a new opportunity to go long, potentially. But if you let the loss get really big, then by the time it does come back up, you might not even want to get back in. So there's no way of preventing ever getting caught in a bull trap. It'll happen from time to time. That's just the way trading is. Again, trading shouldn't be about avoiding loss. It's reasonable to have some fear of loss. just like it's reasonable, I suppose, to have some fear of falling off a bike or falling skiing. But you don't hear of a mountain biker or a skier that never falls. And if they never fall, then they're not pushing it. Now, when we see Granny on a bicycle, we're going to say, Granny, take it easy because we don't want you to fall. Because if you fall, it could be catastrophic. You could break a hip. Say the same thing to Uncle Steve. And so that speaks to if you're trading with a very small account, you're going to have to be very cautious. You're going to have to be a lot more protective of your equity because you can't afford too many losses before things are really bad, right? So as a result, you're going to focus on higher quality setups and try to mitigate risk in all the ways that we talk about as we go through the class. But ultimately, when you get into a place where you've built a little bit of a cushion in your account and you're feeling more confident, that's when you're not going to want to trade just purely every setup to just avoid loss. You're going to want to be taking what you see are good quality setups. And sure, stub your toe, but let's not break your hip. That's a great one. All right, so the best remedy is to exit immediately and to learn if you see some red flags that they can indicate a higher likelihood of bull traps. So learn from losses. Losses are lessons. Previous history of false breakouts, extended charts, large sellers on the level 2, perhaps hidden sellers on the level 2. Bull traps can happen in any pattern. Bull flags, flat top breakouts, whole dollar breakouts, VWAP breakouts. Bear traps can also happen in any pattern. They can just happen. Sometimes they happen because, the stock breaks over a level and we didn't know it, but someone at E-Trade has a market order to sell, 100,000 shares, profit stop, right? So you can set a profit target order essentially at, whatever, $10 a share. Stock goes to 10 and boom, right there, it hits that level, stop fires, or sell orders fires, and it's a market order, and it flushes down. People panic, it causes a dip. We don't know when these things are going to happen. So that brings us to the end here of Chapter 5, and we will continue on with Chapter 6. Those watching in the Learning Management software, as always, you guys can be doing your quizzes in between these chapters, and we'll meet you back for Chapter 6.